I want you to take a seat at your own table of your wealth, because when you're able to participate in the conversation and say to your advisor, I did this research, this is what I'm thinking for this company, and then have conversations back and forth with your advisor about that, you're going to notice a significant shift in your ability to protect your wealth. Welcome to episode 25 of the Visionary Investor Podcast. Today I want to talk about having a more open mind when you're investing in the stock market. Because at the end of the day, there have been few investors who have beat the market, but there have been investors who have beat the market. And when we look at past data, we can clearly see that you can create a concentrated portfolio with just 3 to 7 strong large cap stocks and beat the market. I just want to teach you about alternatives to investing into 20, 30, 50, 100, or hundreds of companies through different index funds, through different mutual funds. There's so much more out there. And from the 1996 chairman letter of Berkshire Hathaway, I'm going to quote what Warren Buffett and Charlie Munger said. What an investor needs is the ability to correctly evaluate selected businesses. Note the word selected. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Investing in companies that you can understand well is so important. And at the end of the day, it may be great that your financial advisor has done all the research for you, but what can you truly stand behind? I want you to take a seat at your own table of your wealth, because when you're able to participate in the conversation and say to your advisor, I did this research, this is what I'm thinking for this company, and then have conversations back and forth with your advisor about that, you're going to notice a significant shift in your ability to protect your wealth. In some recent conversations I've had over the past few months with different investors, I've noticed that a bunch of them have been talking about how difficult it is to beat the market. This is common all over. We hear this all the time. And it's proven that you can beat the market if you know how to properly value a business and make strong predictions of where that company is going to be in 5 years, 10 years, and 15 years from now. You can take that knowledge to invest into great companies at undervalued prices. Plus, if you know what's going on with recessions and economic downturns, those are great times to add additional capital into the stocks that you already have done your due diligence and research on and feel very strongly about over this next 5 to 15 year time period. While there are 3 main ways to value a business, you want to use certain assumptions to make stronger valuations. There's the comparison method, there's build-up, and there's discounted cash flow. The comparison method, you're looking at similar companies in the industry. You're potentially using different metrics like EV to EBITDA. Essentially, you're looking at comparable companies within that industry or sector to determine what the share price should be for the business that you're looking at. The build-up method, you'd be valuing all of the company's assets and components, which can be quite difficult with a large public company. And the discounted cash flow method is when you're taking future projected earnings, discounting them back to the present so you can say today what you think the present value of future cash flows will be. I get this question all the time, and you hear this all the time. How do you value a business better? It's by making stronger assumptions. The more you understand about a business, its core operations, which I've talked about in other episodes, the more you understand about the company's customer base, how they do business, what are their risks of operating, who are their competitors, and how do they stand out? How do they have competitive advantages? And do you foresee them still having these competitive advantages in 5 years, 10 years, and 15 years from now? The more you can understand that, the stronger price predictions you'll make for the company you're looking to invest into. At the end of the day, if you pick 5 strong companies, you valued the companies and you see that they're significantly undervalued, and you continuously do those valuations, whether that's every 6 months or every year, and you notice these companies are still undervalued. And you're also making a great return over time, because at the end of the day, what is the stock price based on? It's based on the supply and demand, which is based on the fundamentals of a company, because companies that are performing well and their financial metrics are doing well, they're beating their earnings, they're treating their employees right, they're properly managing the business, they're managing cash, you're seeing positive effects across the board, these are the companies that rise in stock price over time. It's very easy to go invest into companies without actually valuing the business. And it's very common. I challenge you to make sure you're doing your own evaluations because you want to understand, where is this company going? By relying on someone else's opinions and expertise, you take away that power. You take away your seat at that table. Because I can guarantee you that if you learned how to do your own evaluations and you valued a business that you are invested into currently or plan to invest into in the future, you'll notice there is a difference between what you value the company at and what someone else values the company at, because there are so many assumptions that go into valuing a business. But the more you do these valuations and the more you learn about different businesses, the better you'll become at valuing a business for the long term. The numbers speak for themselves. If you have 5 strong companies and their stock price continuously rises, except obviously when there's an economic downturn or there's potentially some difficulty in the industry, but overall the companies are performing well and they're rising, you're going to have an incredibly valuable portfolio. This is how you can target 15 to 20% plus annualized returns, because you have strong companies in your portfolio. Look to buy quality assets, not buy a ton of different assets with different varying qualities, because there are thousands of companies on the exchanges that don't have strong stocks. But there are plenty of companies that have very strong stocks, have performed very well in the past, and may continue to perform well in the future. You can see this by doing your own valuations. That's not to say that there won't be years or time periods where said great companies don't perform as well. But if these companies truly are strong fundamentally, they have a strong management team that knows how to pivot during hard times, you'll notice this company over the long run should be able to continue to grow and continue to make great returns for you in your stock portfolio. The backbone of investing comes to buying strong assets at undervalued prices. If you see that a company that you really like has come up with a new product that you believe to be incredibly revolutionary, you've done your research, you've spoken to other people about this product, and you still feel really strongly that this company is a home run. If you've done your research, you can say to yourself that you're ready to invest into this company. If you choose 1 or 2 companies in your stock portfolio that do not perform well, this comes down to how good of research and projections did you do? Because of course, having a smaller number of stocks can be risky if you don't properly do your research. Why not take investing into your own hands? Even if you're working with an advisor, just like having a doctor or other health resources that you can reach out to, why not learn how to invest on your own, to do your own research, to predict and project companies? Learn how to properly value a business so you can find undervalued stocks, buy stocks below fair value and sell them above fair value, or when you notice that the fundamentals have changed significantly to the point where you no longer believe in that company, where you see that they're going to have difficulties in the long run maintaining their competitive advantages. Look at the businesses in your town, look at the businesses that you frequently shop or go to. Ask questions. Think in more depth about these businesses and what makes them successful or what doesn't make them successful. Look at the businesses that have gone out of business and see what they've failed to do. And by understanding more about this process, you're going to learn more about what makes a business successful and what doesn't. I strongly believe that by not doing your own research and not learning how to value a business, you put yourself and your wealth at more risk because you're relying on someone else to do that for you. And at the end of the day, do you know exactly how they've done it? And even if they showed you, would you understand their methods? See, that's the difference of when you can value a company on your own and then your financial advisor or someone that you trust shows you their valuation, you can look at it and understand where there may be downfalls or where there may be opportunities to improve upon. The thing is, when someone has 100 companies in their portfolio or an ETF with hundreds of companies in it, it's very difficult to do a discounted cash flow valuation of all those companies with precision. It's very difficult, even with a large team, to be able to understand all of those companies and apply methodologies to properly value those businesses. Can it be done? Of course. But combining all of these companies together and understanding the weights of them and how they work with each other or not is very, very complex. Have an open mindset no matter what you hear on Wall Street, no matter what you hear in the news about investing, about what's going on. We rarely hear in the news, oh, this company in the next 5 or 10 years is expected to do X, Y, and Z, which is going to significantly increase its value in the future. But when you do your own research, you'll be able to make those predictions. You'll be able to see which companies are more likely to succeed in the future and which companies may lose their competitive advantage and not succeed in the future. In order to master the markets, whether it's a bull or bear, make sure to value your own investments. It's not the amount of companies that you have in your portfolio, it's the quality of those companies in your portfolio. When I say 3 to 7 strong stocks can make an amazing stock portfolio, people think this is so risky. But if you're investing into 3 to 7 strong quality assets, the risk is only what you perceive it to be. Because if you've done your valuations and you're consistently accurate with your valuations, which can happen contrary to common belief, then you're investing into 3 to 7 strong companies that you're projecting to grow over time, that you're projecting to make you more and more money every year. Of course, things are going to happen, but when you're doing your evaluations, you can determine, is this a good time to buy because the fundamentals haven't changed on the business? I still believe it's undervalued. The sector itself is just having trouble, which is dragging down the stock price in the shorter term. Look longer term and beyond, especially when you're trying to protect your wealth. In order to master the markets, whether it's a bull or bear, I encourage you, learn how to value a business. And if you want more information, if you want to learn how to do this, send me an email, support@thevisionaryinvestor.com, or click on the link below to apply to the Protect Your Wealth program. Correctly valuing businesses can be really fun. Truthfully, I enjoy looking through a business, looking at all the components and trying to come up with what I believe the future price is going to be. While it may seem challenging to some, the more you do, the more comfortable you'll get with doing this method. And this has proven to be incredibly successful, rewarding, and to protect your wealth. Don't invest into companies that you don't understand just because someone else is telling you it's a good investment. You want to be able to do the research yourself to get your mind and your heart set on what you think is a good investment for you. Some people don't mind the fluctuations that Tesla have had. Other people may look at Tesla and say, personally, I don't believe management is the type of management that I want to invest into. Or they may say management is exactly the type of team I want to invest into. This is what makes everything different about you investing versus me investing versus anyone else investing. But to look at something and say, you know what? It's impossible to target 15 to 20% annualized returns over the long term. When you think this, you're bringing that into your reality. Having an open mindset, being willing to learn and doing the research yourself will show you what a strong stock portfolio could look like. And you don't have to invest like everyone else. You don't have to follow along with what everyone else is doing in the stock market. Just because the market went down X% doesn't mean your portfolio has to go down X%. Just because the average returns are 5 to 10% annually doesn't mean that those have to be your average returns. And just because someone's telling you that there's a ton of risk in this type of portfolio doesn't mean that there actually is. That is their perception. At the end of the day, if you've created a portfolio and you look back and you have 5 stocks in it, and I'll pull something up on the screen here, I'll show you 5 stocks that over the past 10 years have performed very well, and I'll show you 5 stocks over the past 10 years have not performed well. 10 years ago, someone may say, all right, Andrew, this portfolio is not going to perform well. There's way too much risk. And then that portfolio, as you can see, went on to do incredibly well. And likewise, someone may say, Andrew, this portfolio is going to perform really well. And that portfolio ended up not performing well. This all depends on how well you're doing your research. Take a look at the companies you're investing into, value each business, and project what you think the stock price is going to be 5 years, 10 years, and even 15 years from now. 15 years can be quite difficult, but the purpose of doing this is create a range. Where do you think the company is going? Do you think that other competitors may come in and take over market share of that company? Or do you believe that this company has been able to continue to innovate in their industry and will continue to remain a market leader? Thank you so much for listening. Make sure to like, rate, and subscribe to the podcast and continue listening and watching everywhere you get your podcasts. Have a great day.